Hi, and welcome back, everyone, to Tactical Portfolio Weekly. I'm Michael LeBlanc, Senior Portfolio Manager at Canaccord Genuity Wealth Management and Senior Partner of LLC Private Wealth. Thanks for joining us for our weekly update. This week, we're going to talk, of course, give you an update on what's going on in the portfolios and strategies in there. We'll talk about the markets and what we're seeing in January so far. Obviously, a really great month. We'll talk about bonds, where patience is finally paying off. We're going to cover off of this earnings season that we're in the middle of. Of course, we have to talk about inflation and many more things. So let's kind of jump into things and get you updated on what's going on. Obviously, January, we've seen a great start to the year for the markets. A lot of it's been, kind of bouncing back after tax loss selling in December, but also a lot of it has been driven by the idea that maybe we're getting through this inflationary period. The Bank of Canada, of course, did their rate hike, looking at doing a pause going forward. Maybe we're done. There's still rumors of a rate cut later on this year. Certainly, that's our hope that we can continue on at this pace. The U.S. Fed is announcing today, expected a 0.25% rate hike, and also expecting to signal a bit of a pause. Maybe it's not aggressive as pause as Canada, but certainly indicating a slowdown, which is definitely what the market's been looking for. So a lot of things going on the inflation front that are looking much more positive for the markets and a lot of the sectors out there. So, and which we'll get more into that. But no sector or no asset class has benefited more in January here than the bond market. Of course, we've seen a really nice rally, or I should say bounce back on the bonds. The patience that we had to endure in the portfolios over the last 6 to 8 months has certainly paid off. We were able to really build some quality positions in there at great pricing. Some of the yields over 9% currently in the portfolio, and bounce up, more than 10% so far this year. So, if you're in a portfolio that has exposure to fixed incomes, those have been really generous so far in the year, and we expect that to kind of continue as if we are expecting rate cuts later on this year. The fixed income side of the markets could actually outperform a bit, certainly in the first quarter if we stay on track. The energy exposures in the portfolios also have been doing well. We've seen a continued strength on the demand side there. Not a ton up on the price. It's been bouncing in its normal range, but profits for the corporations in that sector has continued to be strong, and expectations that we're going to see even higher fuel prices for this summer as the conflict in Ukraine and between Russia continues. Of course, that will only lead for more profits for those companies. So they still have a healthy exposure to the resource sector in the portfolios. Probably looking at lightening that. I've mentioned this before, looking at lightening it later on in the year, but definitely a key part of the portfolio right now. Metal gold, through 2022, demand has been really strong. We've actually seen some good moves in recent months on the gold price. As interest rates continue to rise with central banks around the world, the gold has continued to strengthen. Where that goes from here, it's tough. It certainly didn't perform in 2021 and early 2022 as most people expected, but demand continues to rise. So that should reflect back in the prices as we move along. As I mentioned earlier, we're in the middle of earnings season, so a lot of things to look at there. Spotify announced they added a large number of new users, but reported losses after some big investments into their podcast names. Obviously, given big bonuses for new onboarded new talent, such as Joe Rogan and Michelle Obama, Kim Kardashian, if you follow those ones on your podcast. But that's really affected the bottom line for the quarter. So good news, they're adding more and more users, but getting hit a bit harder on the cost side of things. We're also seeing on the drug front, or on the healthcare front, we've seen some moves with AbbVie, which was one of the positions in our portfolios. Their blockbuster arthritic drug has been driving some pretty good profits for them for the last couple of quarters. It just went to generic, so the first low price copycat is out there. How that's going to affect them, probably not much in the beginning. Obviously over time, as the brand name gets watered down, tends to be the trends that we see there, but nothing we're concerned about immediately. And of course, Pfizer has warned going forward some much lower growth numbers in their sector as we wind out of those profits from COVID. Also on the profit front, Airbnb and Expedia has been turning people's cash into profit. So we're seeing this more and more, and it's a common theme, which is one of the reasons why we really like the Canadian banks. Is your cash deposits in the bank, companies make money on that. So Airbnb and Expedia, as you put those deposits down early, and that money sits in the bank, they're making pretty good interest. In fact, daily interest these days is between 4.5% and 4.9%. They're able to pocket that just on cash sitting in the bank accounts or in your deposits. That's the same with the Canadian banks. We quite like them. They make a really healthy spread on cash and also on deposits. So their profits on that side of the business will continue to do quite well. UBS went out and announced they're doing quite well, attracting a lot of wealthy clients. Most of that is coming from Credit Suisse. If you've been following that story, Credit Suisse has been having a lot of financial troubles, doing a lot of restructuring. In the meantime, clients who are concerned about the ongoing viability of Credit Suisse have been jumping ship, and UBS has been one of the main international companies to pick up on that benefit. On the tech front, we still haven't moved really heavily back into tech. I think it's still a little bit early, to jump on it. And if you look at the stories, out there, a lot of layoffs happen, still a lot of cost cutting to happen around the tech companies, which will play out to the positive at one point. Their cost of cash is getting really expensive for them, as tech companies generally have to borrow and raise capital in order to continue to grow. And these higher interest rates are obviously weighing on them. And so they're in cost cutting mode right now, not really in growth mode. So I still think it's a little bit early. We're also seeing on the chip side, we went from not being able to get a single chip anywhere during the pandemic to, almost having a surplus, and still some continued wars going on there. The Biden administration is considering cutting off Huawei from U.S. suppliers as they try to shift more technology to mainland United States, more manufacturing. Also the threat of the offshore information fight that the U.S. is having, and that's all wrapped around kind of the TikTok theme, which the CEO of TikTok will be in Congress this week. But we're also seeing Samsung kind of coming out to say they expect their numbers to be a bit more sluggish going forward, as the demand for the semiconductors are falling off quite a bit. And some of this around the crypto story. Of course, if you followed anything in crypto, it had a really tough year in 2022. A bit of a bounce here in some of the main names like Bitcoin to start off the year. But all that farming or mining for Bitcoin or mining for cryptocurrencies, which has a huge demand on the chip market, seems to have fallen off all through 2022. So chip manufacturers, particularly Intel, also signaling slowing demand, and that'll probably translate to other players like NVIDIA and others in the space. So something to keep an eye on. As I said, I do still like the tech sector, just probably not the right time, certainly not in the portfolios. We're not looking to increase a ton on that front. We're also seeing lawsuits, as I mentioned, around the crypto world. Alameda Research is suing a bankrupt crypto leader. And I know you're probably sitting there saying, well, which one? Well, Voyager for about $440 million. We've got FTX, there's lawsuits flying around. There's so many problems in the crypto market right now due to the just collapse, a domino effect of one or two of them going. And then we're seeing kind of, that play out in in kind of an unregulated market or not highly regulated market, it was tough to see all the different pillars that were going to come down when that started to fall. But turning our thoughts back to inflation again, one of the things we're really looking at is the labor market. Obviously, we're seeing pretty low numbers on the job rates, which is good and bad when it comes to inflation. There's a lot of layoffs happening right now, so I think those jobless numbers are going to increase. But the other numbers that we're seeing, should see later today, is the worker pay and benefit data. So kind of seeing how much worker pay is increasing due to the labor shortage. Obviously, the more desperate companies are to get labor, but also qualified labor, they have to pay up more, so we'll get to see a little bit more as to how that's playing out and where that's going to be headed over the next little while. So that's something to really, that we're going to focus on the portfolio, not only because it will give us a bit more insight to kind of where that inflation number is going in real time, but also because we'll get an insight and see what companies or what sectors are having to pay up extra, and that's going to affect their costs and profits. So labor is now more of a focus, I think, than inflation. If you've talked to me in the last month or two, I think the inflation numbers have pretty much played out. As far as interest rate hikes go, we still are seeing inflation being impacted a lot by fuel costs and food costs, but those two are outside of the supply chain issues. Obviously the war in Ukraine is affecting a lot of the fuel costs. And on the food costs, it's a lot about the extreme climate we've had over the last year or two, whether it be storms or record heat or drought, prolonged drought in the United States, have affected the agriculture industry. So those things combined are affecting the food supply chain, and that's causing the prices to stay higher when it comes to inflation, and that's not really going to be corrected by higher interest rates. So labor is kind of the one we're keeping a really close on right now. Private equity, you've probably seen, if you follow anything, private equity has been really kind of a theme over the last year, and as far as our view goes, it was a great theme probably about 2 or 3 years ago. It's kind of played out, and we've certainly seen the amount of money flow into private equity over the last 6 months, almost record highs, especially around insurance companies. We've seen a lot of them getting taken out private by private equity. Usually when you see a big flow or a big, pile on into a particular area, it's kind of that, that song is played out. It's pretty much over. There's still going to be some areas of opportunity to take advantage of, but it'd be a lot more selective if you're looking at anything like that. And as always, you can reach out to us and run it past us. We're happy to discuss looking into it any further and give you some insights where it might make sense for you to use it in your portfolio. We're also seeing interest rate hikes overseas. In fact, the European Central Bank is probably looking at a 0.5% hike. They're still at 2%, so a half's only going to take them to 2.5%. Their inflation numbers are still staying pretty high, and they still have bigger issues than we have over here. A little bit behind us as far as interest rate hikes have been going, so they still have a bit further way to go. We're also seeing the global outlook getting a little bit stronger with China reopening, manufacturing numbers rebounding. Obviously, a close eye on the pandemic infection numbers over there, but there is quite a bit of optimism around them getting back to things, especially things like travel. And of course, that's pushing the oil prices up a bit as they expect to be more demand out of China when it comes to the oil demands around the world. Stocks and bonds, I talked about the bonds. Of course, stocks have had a great rally. The portfolio has had an amazing start to the year. In fact, depending on your particular risk strategy, you might be at new highs and certainly recovered back to early 2022. So pretty much picked up the last 8-9 months of volatility has been gone out of the portfolio as of the end of the month here. So really great news on that front. And we still have a lot of cash in the portfolio to take advantage of what we expect to be still a bumpy quarter, both in the equity side, but still opportunities in the bond market. And if you had money outside of our portfolio last year and you haven't seen that recovery, I recommend you go to mikeonmoney.com. And one of my videos from 2021, it talks about 60-40 portfolios and how those really don't work that well anymore. And I think last year was a great example of that. 40% bonds, 60% equity is supposed to protect you in a down market, when in reality they both went down and actually doubled or increased your risk in your portfolio by having that balanced or 60-40 split. Our tactical approach is different, and that's why we're able to weather the storm and recover so much faster than the markets and those balanced static portfolios. So go check out the video or reach out to us. I'll happily send you the link for it. It's a 10-minute watch. It's worthwhile. And if you have any questions, as always, you can reach out to us and we'll discuss kind of what you experience in those external portfolios and what we might be able to help you with a strategy to recover. Because that's one of the things, if you went for the full downturn last year, that's one thing, but what's the strategy going forward to make sure that you recover that as quickly as possible? We're seeing more and more investment into green technology. Of course, that's an area of the portfolio that we look like. There's more and more subsidies being pushed. I'm sure you've seen them here in Canada, the US. Of course, the Biden government have a lot of green subsidies out there to encourage people and industry to shift. And EU is no different. They're getting on board with a lot more subsidies to help industry and people shift away from kind of the older technology. I wouldn't even say fossil fuels, because it's more moving towards cleaner tech, but also more efficient technology. And that's going to continue. I will say, though, when it comes to green tech investment, do be really careful. Greenwashing is a thing. A lot of times you think you're getting into an investment that is focused on green technology or a green path, and they're not. So there's a lot of things to consider when looking at that. Also, when money is nervous, like it has been, it will not go to new areas like that. It will hold back and wait for greener pastures, pardon the pun, but it will look for better opportunities in the shorter term, rather than kind of pile onto a theme that definitely is moving forward and definitely is an area of growth, but it might be a little bit not the right time, I think, to go too heavy into green tech, but certainly an area to look for opportunities as things move forward. So with that, it's pretty much what we're seeing on the portfolios for this month. We will back, obviously, bringing more updates as we see more of the earnings numbers come out. Things have been going, as I mentioned, very, very well in the portfolio. If you have any questions about your portfolio or anything at all, always go to mikeonmoney.com. Reach out to us. Happy to answer any of those questions. This will be available for review on YouTube. I will send those links out, and also a podcast if you want to listen to it on a drive or just when you're out there relaxing. So with that, I will say thank you, everyone, and I will talk to you next week. Bye now.